special voice, Pramod Gubbi, the Managing Director and Head of Institutional Equities at Ambit Capital, joining us on the show. Pramod, good morning and thank you so much for joining us. Let me just start off with the underlying macros at this point in time. What have you made of the RBI's monetary policy yesterday, and what is your anticipation with respect to the interest rate trajectory? Thereby, what could it mean for the Indian equity markets?
I think the RBI's move was pretty much in line with our expectations, given the developments in the economy, which is clearly marked by a very strong recovery in underlying demand. To the extent that, like the RBI governor put it, I think we've pretty much closed the output gap now. Any further increase in demand without a supply-side response is going to be inflationary in nature, and that's pretty much why the RBI took that preemptive rate hike to address any sort of spike in inflationary expectations as we go by. Alongside that, if we have the government spending on rural development programs, MSPs and so on, that will add to the inflationary pressure, and that had to be dealt with right away. Going forward, I guess there's at least one more hike this side of the calendar year before, at least one more hike, if not more. And it all depends on, I guess, how the government goes about implementing the MSP program, particularly the procurement policy, which would be out sometime in September. Depending on how that goes about, we can ascertain how much of first round or a second round effect on inflation that could bear, and that could drive further interest rate hikes or just one, like I said. So yes, I guess there's one more coming at least.
Interesting. Pramod, what have you made of earnings thus far? I've now seen 3 notes in the last 2 days. Some talking about how, had it not been for the 2 corporate-facing banks, the numbers would have been largely in line. Citi's note today seems to suggest that they are very happy with the earnings thus far, and they believe the rest of the year holds in store a potential to have another 25% rise in numbers too. What have you guys at Ambit made of the season thus far? What stood out for you?
I think it's been a good earnings season. But definitely, we are seeing recovery in earnings, something that the market was desperately anticipating, given we had 2 years which were disrupted by different sort of events, be it the demonetization or the GST. I think while I would acknowledge that the earnings have been strong, we need to concede that some of it is because of the base effect that we saw last year, June quarter, which was the quarter which was anticipating the GST move, and there were sort of inventory sell-offs and stuff. So, and hence, you could have seen better numbers because of that weak base in some ways. Having said that, I think we are in line for perhaps our first, close to double-digit earnings growth for the index after almost 4 years. So we are headed in the right direction as far as corporate profitability is concerned. But then, valuations are a different matter, whether valuations have already factored in. In fact, valuations have been anticipating these sort of earnings recovery. It's about whether we can improve from here, from consistently seeing downgrades over the last 3-4 years. Can we see the first earnings upgrade cycle? That is what will drive markets further. That is what will drive valuations, which are already, like I said, anticipating this sort of an earnings move.
Right, Pramod, let's talk about a few sectors. At this point in time, we've had earnings of a lot of these auto companies come through. What have you made of the sector? Because we're clearly seeing some amount of volatility, despite the fact that earnings have not been so bad. What do you make of them, especially keeping in mind the valuations at which they're currently trading at?
I think autos have been, a strong performing sector over the last year or two, in anyways, except maybe for two-wheelers, which perhaps are seeing some signs of recovery now. But I think each category is slightly different from the other. To that extent, I think commercial vehicles have some more legs to grow, given given the sort of underlying drivers, be it regulatorily or build up. But having said that, I think the sustainability of those volume growth is the question there, and which is why I guess the markets have reacted the way they have. Of course, there have been a couple of regulatory headwinds as well. On the passenger car side, I guess there are not too many plays, but whatever is there is doing well. But having said that, valuations aren't cheap there, so valuation is an issue there. So that leaves us with the two-wheeler side, which is perhaps a little more promising given valuations aren't that high, yet we are seeing some sort of signs of growth coming, particularly in the form of exports, also in the form of premium bikes. Yes, there is a beginning of what looks like a price war at the entry-level bike segment, which could spoil the party. But of all the three segments, I think two-wheelers perhaps has, on balance, the better prospects within the auto sector.
Interesting. The belief from the Fed commentary seems to be that there will be hikes, two hikes, and you already adhered to that. Let's work with an assumption, Pramod, that there is weakness in the currency which will last, or at least the rupee will not recover some of the lost ground over the next 6 odd months. Does that put the exporters and in particular IT in a good shape? I know neck to neck, or rather net for net, there may not be a material earnings upgrade purely because of currency alone, but at least that small bit of tailwind exists and business momentum seems to be looking strong, at least if TCS and HCL Technologies are to be believed.
Yes, indeed. I think that's a nice little tailwind, and I agree. I mean, fundamentally, there are other drivers which are working for IT, be it the overall IT spend. We are seeing the interest rate hike cycle putting profitability of some of the US banks, which is a large customer segment for the Indian IT sector, in better shapes, and that's driving IT spends at the macro level. And on top of that, I think the initiatives and the investments that the Indian IT sector has made in terms of some of the new capabilities is clearly auguring well for them in terms of taking market share and, in terms of order win growth as well, as the commentary by these guys suggested this time around. Alongside that, if you have a slight depreciation in the rupee, of course, it's clearly a nice little tailwind. While valuations aren't as cheap as what they were, say, 12 or 18 months ago, we've had a nice rally in the sector. But I think, it does have some more legs to go.
Right, Pramod, earlier we had the MSPs come through from the government. A little later on, we've had GSTs on a lot of consumer durables be reduced as well. This is clearly towards government trying to provide some impetus when it comes to consumption in India. That said, we're still looking at valuations. They are where they are at this point in time, especially when it comes to some of these staples. My question really is, what would you do at this point in time when it comes to staples? And perhaps if you could also offer your view on discretionaries.
I think consumption will remain the key driver for the economy. It has been, the investment cycle has been missing for many years now. So it has been consumption which is pretty much, keeping the economy going. And that's likely to continue, given the demographics, and also in the short term, given the political imperative to drive electorate. You will see some of the spending programs in that direction, and that will keep consumption quite robust. Having said that, I think valuations are perhaps at their highest levels across staples and discretionary, reflecting this sort of both a cyclical push and also a structural uplift in growth driven by formalization and the other changes in the economy. So on balance, I guess from a short-term perspective, you have some comfort in the form of growth visibility. In the longer run, I guess you just have to hope that these companies continue to compound at these rates for a long time to justify these valuations.
Okay. Pramod, my final question really is about whether post-earnings, post-correction, etc., I know you guys have a tilt towards the large cap because your institutional clients would be looking at the larger names, the foreign institutional clients at least. But is there, after this bit of an uptick from the lows at the mid cap and the small cap end of the market, a better risk reward at the mid caps and the small caps, or would you still be comfortable with the large caps? And I don't mean just the Nifty, but let's say the top 100, top 150 names.
No, I think it's still a more selective game, both at the large and small mid-cap game. There have been instances where the correction has been perhaps overdone or leaving some value on the table, but by and large, on a broad basis, I don't think the correction has been enough, and particularly, valuations are high, but also we are running into a period of further uncertainty. We will have political issues crop up as we progress towards the end of this year. We will have some sort of global macro also worsening. We're seeing, the liquidity tightening happening. So both from a global and local macro perspective, it is not a particularly great time to be invested in small and mid cap, barring the selective cases on a bottom-up basis where we're seeing very strong fundamentals backed by attractive valuations. So I would use a bottom-up stock-by-stock basis rather than trying to buy small and mid cap as an asset class.
Right, Pramod, we'll leave it at that. Thank you so much for joining us and taking us through your views on the markets.
You're welcome.